All right, welcome back to another edition of Intermediate Accounting 1. We're going to finish up the Chapter 11 lecture with Learning Objective 4, talking about depletion. What is depletion? Depletion is kind of like draining or depleted. Like if you're drained of energy, you are depleted of any energy. Depletion is kind of the same thing, only applies to specifically natural resources, such as an ore mine or an oil reserve. Often called wasting assets, which is sort of a negative or a derogatory phrase. So I've rarely seen it called that. Natural resources, what people tend to call that stuff. It includes things like petroleum. Oops, excuse me, petroleum. Can't even spell. So a lot of you may end up working or be associated with the oil and gas industry or the energy industry. So natural resources is a major part of those industries, those businesses. Minerals and timber. If you're from the Pacific Northwest like I am, timber is a major natural resource. There are two main features of natural resources. There's usually a complete removal or consumption of the asset. So if we own the right to, say, land that has timber on it, we're expecting to take all of the trees down, fell all the trees, gather them up, take them to the mill. Okay. If we discover an oil reserve, the idea behind leasing the land or buying the land is we're going to suck up all of the oil. It's going to be complete removal. Okay. But there must be also replacement of the asset only by an act of nature. So after we remove all the oil, the only way for oil to get back in the oil reserve is for Mother Earth to put more in there. Okay, so we know that it's a natural resource if one, removal, consumption of the asset by us can only be replaced by Mother Nature herself. Depletion, therefore, depletion is the process of allocating the cost of the natural resource. It is the consumption, if you will, of the oil in the oil reserve in so much as or insofar as we are going to sell the oil. So a major feature about natural resources is when you think about a balance sheet, assets equals liabilities plus equity. Okay, we have our current assets and we have our long-term assets. Okay, oil reserves will start off as a long-term asset, but through depletion, we will pull the oil out of the earth and place it into inventory. So that is what is called depletion. When we pull oil out, we put it into barrels, we get it ready for sale. That is the depletion. We're depleting the oil reserve. Once it goes into inventory, then it ends up as cost of goods sold when we sell it. That's the idea. So how do we establish a base of depletion? How do we determine how much is going to be, how much value there is in the oil down below in the earth? So we're going to calculate a depletion base, kind of like somewhat similar to depreciation or depreciable base. Similar to this. We're going to build it up. How? Well, we have lots of costs incurred to acquire an oil reserve. First one, we're going to have acquisition costs. And we're probably going to have exploration costs. Then there is the development costs. And this includes both tangible and intangible development costs. Restoration costs. Estimated fair value. And restoration costs, we can't just dig a bunch of ore out of a mine and just walk away. There's a big hole in the ground, right? It's dangerous. People can go in there. The mine could collapse. All kinds of things, bad things could happen. We don't just pay to acquire and pull out the natural resources. We also have to, at the very end, when we extracted everything, put it back into some sort of condition that it can continue on existing without causing any harm to the environment or to people. That gets us to total cost, which is recorded as a long-term asset. And what we have to do, and this is one thing that people tend to forget, is we have to subtract off any estimated proceeds from selling any aspect of the land or the mine itself. So if there is, say for instance, we have some type of development cost that we had to, say for instance, we had to bring in some specialized drilling equipment. We're not going to use it after it's done. We're going to sell it. If there's any proceeds from the sale of that equipment that extracted from that particular area, the proceeds are going to be subtracted to get us to finally what's called the depletable or the depletion base, whatever you want to call it. Depletion base, depletable base, same idea. Now, once we come up with a depletion base, we're kind of following the same rules as we do for depreciation or depreciable assets. We come up with a base, then we have to figure out how we're going to spread. Whoa, oh, Kevin, don't do that. Goodness. How we're going to spread the depletable base across the useful life. Well, we're going to follow primarily, this is cost depletion. Normally companies compute depletion or the cost depletion on a units of production. UOP method, an activity-based approach. So recall when we're talking about number of hours the machine was used. We take the total depreciation base, or the depreciable base, and divide it by the total hours. Here, it's the exact same concept, only we're taking the depletable base, or the depletion base, and dividing it by number of barrels of oil that's underground, or number of or footboards of timber, something like that, some type of units. So it's the number of, depletion is a function of the number of units extracted during that period. So total cost minus salvage value. If there is a salvage value, we want to subtract that away. Call that is similar to the proceeds from selling. Okay, so total cost minus salvage divided by number of units available gets us a depletion cost per unit. Take the units extracted and multiply it by that cost, and you got yourself depletion. And depletion is not an expense. It's not an expense. We're shifting it from long-term assets into current assets in the form of inventory. So let's go through an example so you can see what's going on here. So I think it's a McLeod Company acquired the right to use 1,000 acres of land in Alaska to mine silver. The lease cost $50,000. The related exploration costs $100,000. Intangible development costs $850,000. So what do we got here? Doing some analysis here. Analysis. Right? We've got 50 lease. We've got 100 explore. And we got 850 in development. So you add that up, 50 plus 100 plus 850, you get roughly or exactly $1 million. Okay. Now, that's the cost, total cost. Okay. McLeod estimates that the mine will provide approximately 100,000 ounces of silver. So ounces is going to be our units. But first, down below, let's go ahead and record the asset itself. Debit silver mine. It's a long-term asset for $1 million. And we'll credit, let's just say they have cash. Let's say they use cash, current asset, for that guy. Okay. So the asset's now in the books. We're going to deplete it using the ounces, number of expected or anticipated ounces of silver that we expect are going to be extracted over its life. So, McLeod extracts 25,000 ounces of silver in his first year. Well, before we get ahead of ourselves, let's take a look and let's ask ourselves, what do we got so far? We've got this 1 million depletion base. And one other thing I want to mention up above too, if it doesn't say, if there's nothing regarding any type of proceeds or salvage value, just presume that there is none. Okay, so this is our total cost, and it also happens to be our depletion base. So keep it simple. If I tell you what the proceeds are from selling any of the assets, that will be subtracted from total cost. Here there are none, or there is none. So let's just go ahead and move forward. The depletion base is $1 million. We're going to divide that sucker by the 100,000 anticipated ounces of silver. And when we do that, we get $10 per ounce depletion. Then, don't forget, we have to take the 25,000 in total ounces extracted, 25,000 ounces, times $10 per ounce. Ounce. It's a weird word. That's going to get us total depletion of $250,000. So it's not an expense. So don't debit depletion expense. There's no such thing. We want to debit inventory. Silver, which is a current asset. 250,000. Where is it coming from? Guess what? It's coming from the silver mine asset. It's a long-term asset. So we're shifting from a long-term asset to a current asset in the amount of 250,000. When it gets sold, McLeod will debit the cost of goods sold account for however much it's sold. If it's 250,000 it's sold, it will debit cost of goods sold for 250,000, and it will credit the inventory silver account for that same amount, just like we would any type of sales of goods. That's all you need to worry about for Chapter 11. I look forward to talking to you again for Chapter 12.